Institutions at Zions.
Thank you. Thank you, and good afternoon, everybody. Welcome to the panel on global economic sanctions and the impact of sanctions on transaction banking industry. My name is Miriam Ratkovicova. I'm a managing director with Deloitte, and I will be moderating today. And so it was probably yesterday, probably very early in the morning during Todd's opening remarks when I first heard the reference to sanctions. And so I decided to start a mental count, every time I heard the reference to sanctions or AML or financial crime, and full disclosure, that's what I do at Deloitte. So a bit of a geek in me. And I think I ended at 10 or 15, and then I lost the count because it became very obvious that sanctions are very impactful on our business, and they have been actually extremely disruptive to banking and transaction banking. And so I actually decided to ditch the polling question. I was going to ask the audience about the level of impact that sanctions have had on your business over the last 12 to 14 months. And I know polling questions are fun, and if we do have time at the end, I will put it up. But at the same time, I know we are running late, and so we will try to do the panel rather than the polling. But before I get into my expert panel of speakers, I would just like to level set the expectations about this panel a little bit. So Russia invaded Ukraine about a year ago, actually 14 months ago. And US, UK, EU, and many other Western economies have rushed to very quickly to impose economic sanctions against Russia, with the objective to depower their economy and to minimize their ability to finance further military actions. And so 1 year anniversary, right, over the last couple of months, there have been a lot of publications and papers and opinions around how effective have these sanctions been on Russian economy. And there are really two types of point of view. On the one hand, you have these studies which say they have been very effective, even devastating to Russian economy. But then you also read a lot of papers that are much more skeptical. And they say that, well, we haven't actually seen the impact that we were hoping. In fact, if you look at the Russia GDP for 2022, it only went down by 2%. And some are even going further to say that it has actually, in a way, benefited Russian economy. Specifically, Russia was able to leverage these sanctions almost as a trade protection policy, and it has actually boosted some of their sectors where instead of importing certain goods, especially high tech, they have been able to replace our automobile industry. They have been able to replace that with internal production. And so a lot of debate I'm sure we could talk about, but for the purposes of this panel, we have decided to take a different spin on the impact of sanctions. And rather than discussing the impact of sanctions on Russia, we have decided to discuss and share point of views on the impact of sanctions on us, on the banking industry. And what we have realized is that while we are all impacted by sanctions, depending on who we are within the industry and the role we play, the impact has been actually quite different. And hence the very heterogeneous panel of experts. And thank you for the introductions. We have Stephen, who represents, he's a global head, by the way, he's a global head of sanctions for Royal Bank of Canada, and therefore represents a large global financial institution, the largest bank in Canada, one of the largest banks around the world. And with his rich experience of 20 years in the space of sanctions, AML, etc., he offers perspective from a large bank. We also have Mark Garfield, who I think doesn't require a lot of introductions, the ex-chair of BAFT. He is with Zions Bancorporation, and he has over 30 years of banking experience, and he is the head of global financial institutions. And he will obviously offer perspective from a regional bank perspective that operates primarily in the states of Utah and Idaho. And then last but not least, we have Idrissa Diop, who's the director of compliance at Afreximbank, which is a trade finance bank for Africa, and their mandate is to promote intra and extra-African trade. So a perspective from an emerging market. And Stephen, maybe I'm going to start with you and turn to you first. So obviously, huge changes in sanctions regime. Your bank operates in over 24 of different jurisdictions, and there is an expectation that you comply with all of these different sanctions regimes. How have sanctions impacted you? What have been the challenges? And by the way, feel free to also comment on the impact on Russia.
Yeah, sure, I'll comment. Proviso, though, it's the attorney in me. These are my personal comments. They don't necessarily reflect that of my bank, because I often say things that I shouldn't say. Yeah, I use 4-letter words like OFAC in the, right? So to me, that's a very dirty word, but anyway, and I'm sure a lot of you think the same way too. So yeah, it's an exciting year. It's fascinating, right? Like a lot of things happened, you know, media attention pretty much every day, and it's remarkable, and I'm glad to see it continues. Whether it's in social media, you see you know, comments about Ukraine virtually every day, right? So it's important that we actually keep a spotlight on what's happening there by Russia. It's the first time in 20 years my mother actually understands what I do because she watches the news, so that's great. Complicated, right? Not the first time. I mean, I've been doing this for 20 years for other banks and in consulting. We saw it in 2014 in the first Crimea invasion with Russia. It wasn't the same degree, but it was like a new type of sanctions. We're seeing not just comprehensive, but sectoral, targeted. That was new, and it was something that the industry, banks around the world had to grapple with. This is a whole another level of complexity. Now, especially when you start talking about Russian banks being removed from SWIFT. It made it very difficult to move money around. It made it very difficult to move and settle securities transactions. There was a whole other level of, I have to say, hell, because like, from a compliance department perspective, teams were going around the clock for months to just grapple with the change. You saw list changes, new deployments come by daily, right? I mean, there were a couple hundred of them. I think we started tracking them, like how many different regulatory changes there were. The problem that we have is that it's not universal, even though like they'll say, oh yeah, the G20, or we talk about it and we're aligned. No, it's not the same lists from jurisdiction to jurisdiction between the US, the UK, the EU even, and other jurisdictions. We're a Canadian bank, so in Canada, they of course, they want to be different, so they have to be different. Just makes it much more difficult to be able to implement. We've also seen what I call the confluence, right, and the bleeding of sanctions into what used to be a very separate world for banks, the import-export world, right? So you have the export controls, but now you've got sanctions that are covering prohibited goods, luxury goods, but prohibited technologies, right? So that's things like optics, sophisticated computers, right? So these are now on sanctions lists, not just on an export control list. And you're running into this issue, we've seen it in jurisdictions around the world where, oh yeah, I've got my export license, or they've export control say, no, you don't have to worry about that. But then the sanctions folks, no, but the sanctions still apply. So we all have to be very careful around that. And it's like two regimes, right, that are operating at the same time. So it's made life very, very complicated and difficult.
It definitely, sanctions compliance isn't what it used to be 10, 15 years ago.
I mean, in the sense that, oh, look, it's a $100 million fine, right? If you want to be exposed to that, we just saw that with a bank, very local bank around the corner here, right, that got hit in March, right? And it was trade finance related, right, around a legacy platform. So I know if you've seen a lot about digitization, et cetera, and trying to streamline and make things more efficient, which is very important. But we also have to be very cognizant about the oversight and the controls around that technology to make sure you're still complying with the regulatory requirements in all the jurisdictions where there's a nexus for those particular transactions. That's what makes it very, very difficult. And you have to be careful about who you're relying on as a counterparty or as a service provider. That's what that recent enforcement action said.
And on top of that, dealing with potential sanctions evasions and monitoring for that on top of
I mean,
screening.
And that's the other challenge on top of that, right? So you've got like regulators around the world all trying to do their part and make sure that they're on top of this, and they just make it very, very difficult for financial institutions to be able to do business, particularly in the trade area, because of enforcement and the regulatory oversight, which is now bleeding into like the new digital currency realm, right? Great presentations like the last panel, but just don't forget that, you know, depending on the jurisdiction, like look at the OFAC guidance on instant payments, right? Like crypto, new digital currencies, they're transactions, they're subject to AML and sanctions requirements, right? So when you talk about real-time enablement of faster payments, great, that's a great idea, right? And that has to happen. But also remember that when they're international, they're going to be subject to sanctions requirements. And four-letter word, if you don't do it, if you don't comply, OFAC is going to come after you, and you're talking huge fines.
Thank you. So, Mark, let's change the perspective a little bit, right? Obviously, huge impact on a global bank, a lot of sanctions regimes. What about U.S. regional banks?
Okay, so that's a global bank, right? And by the way, just so Zions really does all states west in the western states. So, I've had a career of really meeting all these companies. So one thing I have said a million times, and I think you've heard this, is that we're Main Street and regional banks, really Main Street banks, certainly Main Street clients, and providing the, and we exist so that we can help serve our communities, right? So just one example of the effects of sanctions. Last week, I was going through Idaho. I met with 17 different companies. I met with the U.S. Commercial Service. Now, the U.S. Commercial Service is specifically responsible to help companies understand these sanctions on the business side, right? So they're doing the instructions also, okay? But I'm there we're trying to help them out. So I meet a company that I've known for many, many years, and haven't seen them for a while. The first visit since COVID, and they have been shipping product into Ukraine for many years, okay? For 20 years or so. Well, now they can't do that anymore, right? They've also shipped into Russia. In fact, they said, we just had a large deposit on a product that we had to go there, but we can't get the money back to them, so we just sit on this deposit, nothing to do. So first of all, it's affecting our clients.
Yes.
Okay? Second of all, and this is what our clients say, it's affecting their buyers. And Idaho is an agricultural exporting state. And those buyers are buying wheat and beans and pulse and machinery that's helped be efficient. So there is effect on the buyer too. I'm just saying on the social element, okay? Then as it relates to us, of course cost goes up because we have to do more. But I also say the complexity, and sometimes the complexity is sometimes random to me. And I would just, I work with a lot of, we as regional bank also require services provided by global banks, our correspondent banks. Well, do we have to just comply to our own jurisdiction in the United States? Well, one correspondent bank might say, no, you have to comply to the other jurisdictions. These correspondents say no. So there's a little bit of confusion at times about what we have to do, but there's also additional complexity.
There is a confusion, I do agree. But then there is also the concept of the global banks are equipped, right? They have been dealing with global sanctions for years. So they have been equipped. They have the large compliance teams, right? They have experts that understand the sanctions regimes in other jurisdictions. The regional banks may not have the same level of resources and systems,
yeah,
right?
But I would also say that we know our clients better.
Yeah.
I mean, we're closer to our clients. We do FX for them. We do trade for them. We open their accounts. We might do their commercial real estate. So I'd say we just have more contact points with those clients. And I think sometimes it's confusion. We talked about de-risk. Everybody knows I hate that word because that's more of a rationalization of services in many cases, right? Versus actual risk, true risk regarding sanctions. And it might just be, it's just we have to close the account because we don't have enough. It's a monetary value to it. So sometimes I don't really like that word so much. But anyway, it's just complex, gets confused, and there's additional cost.
It's a great point that you raised, Mark, right? Because there's a cost of compliance, right? Which it impacts what we do, where we do business. I've seen that firsthand, to pick a Caribbean jurisdiction, right? So, not a huge amount of business down there, but in some cases, the regulators have made it so difficult to go through exams and spend so much time. When we looked at the overall cost of compliance in that jurisdiction, we weren't making any money. So then it begs the question, why are we even there? Right? Now it goes to the ESG, the S in ESG, the social aspects. Well, because people won't have bank accounts if you don't provide them the services. So it's important. But I have to say, in some jurisdictions, a lot of it is and it has a lot to do with FATF, of what your country rating is. And if you're putting on a lot of pressure because you've been identified as having a weak financial crime or AML compliance regime, their regulators in country tend to make it much more difficult for banks to operate.
Yes. All great points. I'm going to completely disrupt the storyline now by inviting Idrissa into the conversation Because as I have mentioned at the beginning, all of us have been analyzing, well, how effective have the sanctions been impacting the Russian economy, and perhaps some other economies. I know there are studies on European economies as well, but I think once we've a little bit lost the sight of the secondary impact that sanctions have been having actually unintentionally on emerging markets, and Idrissa brings a very interesting point of view that I think we all need to be aware of.
Yeah, what's happening right now is having an impact on Africa. It's a collateral damage, I would say, because this is not our war, and we found ourselves having to buy wheat because we need to eat, and we found ourselves having to use FX, dollar, euro to buy those commodities. Or if it is not wheat, it is, how can I say, other type of product. And as African bank, we have to satisfy our correspondent banks, because the dollar we are taking to buy those goods have to be processed by them, through them. So then the requirement to align with what OFAC said, what UK Treasury said, what EU said, is on us. And this impacts our spending in terms of compliance, because we need to invest on technology to do that. And once we invest and have what we think is a platform which is strong enough and eventually aligning with best practices, we then face a very strange situation where the correspondent bank is just saying, I don't have appetite for Russia. And today we have situation where grain importers, fertilizer importers are knocking the doors, and they don't have people to process their funds. So it's then, and despite the general licenses, our correspondent banks are writing to us to say, we have zero appetite for Russia. And I understand the logic behind, because they don't want to invest on taking the risk of having issues, having nexuses, etc., particularly when these nexuses are sanctioned. But today, Africa, and I guess that's the situation in other countries which are not involved in this situation, is facing a situation where you are collaterally impacted by the situation. Our FIs, because Afreximbank today is the second largest DFI of Africa. So our mandate is to promote trade. So our customers are local FIs, and behind them they have small, medium enterprises, corporates who wants to buy goods, etc. So today, despite all the investment we are doing to really align and show to our correspondent banks that we are doing the right thing, nobody wants to process our.
You being the
so that's a debate where you then have to ask yourself, okay, what do they want? Because I'm suffering. My population are about to starve, and in the meantime, I have money to buy goods, which may be available to us, but the entity which is expected to process these funds doesn't want to do it. Who do I talk to?
So, Idrissa, I got a question. So, and you're talking about, Russia's a name that everybody, scare everybody, but it's not, it's like, I deal with Venezuela, right? I mean, do stuff in Venezuela. Individuals in Venezuela might be restricted. And I talked to the OFAC officer once out for Colombia and Venezuela. He said, look, there's more people actually in Colombia on the list than there are in Venezuela, okay? But yet Venezuela as a whole is kind of, even though it's not restricted as a country, banks are just afraid of it because of the name.
As a whole.
They'll do business in
because
Colombia,
of the
even
sanctions.
though there's more individuals. Is
that
kind of what you're
designation,
saying?
Yeah, but,
right?
but the problem is when regulators said, we have general license, you can go and help corporates and individuals to buy wheat, to buy fertilizer specifically. And because if you don't do it, you may have a hunger issue. And still,
Still,
you guys are not coming to us.
Yeah, I mean,
That's
because-
today an appetite that you don't have, because we understand that some of the correspondent bank has been heavily sanctioned, and they just don't want to take the risk. But there are human beings behind this issue, and nobody is taking this into consideration.
No.
Okay, I understand that, and what I was having a conversation with OFAC. The problem is that when I told them, can you identify main correspondent bank which have the appetite to really do this with us? Can you induce them to come to us? They still don't know how to do it, because these are private corporates, and they don't have no, how can I say, influence on asking, for example, Royal Bank of Canada to come on board and take the risk.
Yeah.
So there is a disconnect between setting a regulation and then having private institutions which don't want to be sanctioned, to just like step back and then wait for something to happen, and nothing is happening.
Yeah, and I think it's so obviously de-risking is real, right? Actually, the U.S. Treasury just published exactly a week ago. They published a white paper, the first white paper on de-risking, as a follow-up to the AML Act of 2020. They were mandated to do it, but we've had discussion, right? They talk about the issue of de-risking, and that it all comes down to the cost of compliance. But they don't offer any, unfortunately,
solution.
No workable solutions.
And I would like to say, Russia is just the latest
Yes.
situation, but Africa has been de-risked these past 10 years plus, okay? And we have FIs who are doing the effort to really invest on compliance. I was the head of compliance of the largest, before I joined Afreximbank, of the largest retail bank of Africa. I was having 200 compliance officers across 45 countries. And we invested in technology. And it was difficult to convince the correspondent bank that we are doing the right thing.
Yeah.
And why? Because they took, okay, Africa is any more economically viable. It's not bringing enough money. So, and then in addition, there is this compliance risk which are there. So we really don't want to take the risk. And we have seen the withdrawal of the big names from the continent.
Yeah.
But behind, if we bring it to this candid approach I have, which is empathy, there's no empathy in banking. And people who want to grow in Africa, you have interesting project of people having good ideas, wanting to build and get the economy at least at a certain level of development. We cannot do that because we are being cut from global finance because of decisions which are not of our stand.
So I see Todd over here. I know when the de-risking thing happened, Todd said he did go to the regulators, and they said, as it relates to de-risking, they see it as an industry problem. They see it as an industry problem.
Yeah.
And in a way, that's the disconnect, I think, at times.
A real disconnect.
They say it's an industry problem, and when it relates to what you're talking about, exactly what's the unintended consequences of what we're doing?
Yeah.
Right, that was just mentioned in the preceding.
think
What's the unintended consequences? The unintended consequences is that in Venezuela in 2019, an average of 17 pounds was lost because they didn't have enough food.
Yeah.
Right?
Yeah.
And I'm not, we just have our own experiences, right? So I think there is this disconnect because the regulators over here, and our banks, and then we have certain systems, and then there's these unintended consequences, which we talk about ESG, and we had the gentleman talk about ESG yesterday, but it was mostly E. Mostly environmental. Yeah. And the question was, what is social? Well, social to me, there's something we can stand up.
Exactly.
Stand up as BAFT, and they mentioned earlier today in one of the future leaders that BAFT can stand up and say, definitely, a social disintermediation is the islands of the Caribbean who simply can't get a US dollar account.
Yeah. I want to emphasize on one thing. De-risking, sanction, ESG, and bring it back to my African reality, is that Africa is not the continent which pollutes. And today, when we are talking with our credit agency, we are being imposed duties which are not
additional
of our stand.
compliance requirements, yeah.
Actually, we should adapt. We're the one who are impacted by pollution and its effects, we are the one adapting.
Yeah, yeah.
Okay? And when it is de-risking, okay, I understand that in some countries you did have 4, 5, 10 people who have created problem till you get the focus on that country. But it's about 10 people. 10 people cannot make a country to be totally cut from the world.
Yeah.
And there are initiatives which are behind. There are human beings. There are interaction between communities. And you end up having financial inclusion totally inexistent and up to the entire continent being put in silo. And while we know that that's the future. Mm-hmm. So the real debate is we need to have, someone said it in the previous panel, that regulators sit with mainstream correspondent banks to really define what is risk appetite.
What's the risk appetite? And maybe even vivid. Because I think when Mark was talking about ESG, and fully appreciate your point on, ESG for your African banks just add on to the compliance requirements and the cost. But I think where Mark was coming in from in terms of the ESG is to attack de-risking from the perspective of the global banks. And the global banks perhaps folding the additional cost of compliance to avoid de-risking, right? Because you're absolutely right, Mark. You said that de-risking is an industry problem. Partially, yes. And I know that BAFT has been extremely instrumental in helping the banks and the financial industries in emerging markets to uplift their AML programs through education, adding new compliance officers, etc. But that that doesn't bring you to the end point. It is the first step in addressing de-risking. But then there is that second aspect, which is what is the global community doing? And I know, Stephen, you have some perspectives and offer some potential solutions in terms of what Idrissa was saying, collaboration of the regulators, the global national, international bodies, and the global banks.
Yeah, it came up thematically, right? It's just part of it is the cost of compliance, right? So to be able to maintain effective controls, and I think that's going to address your issues. Well, why don't banks do more business there? It's because of either they don't have confidence in their controls or they're worried because of the regulatory regime. It's interesting because if you look at OFAC, although they say banks can take a risk-based approach, right, to compliance, well, not really, not when it comes to enforcement. Because if you actually fail, you get nailed, right? So that's the reality, and then you get big fines. So even if it was unintended, you still get punished, right? So there's no leniency in the regime the way it works today. And because of that, I think that's the decision is if you don't have entire confidence in your controls, well then, we don't want to necessarily incur fines, and so we're just going to de-risk it. We're going to not do that business, especially when it's so complicated, right? Because you're talking about situations where, it is permissible, let's say, in using euros to clear it involving these parties. Oh, but the problem is, it's still it's a contravention of OFAC sanctions. Okay, most banks won't do it, right? Even though it's permissible legally.
Your lack of confidence is mainly driven by the fact that you and I are not talking. Actually, you don't know what kind of effort the FIs in country which are de-risk, the central bank of country which are de-risk. If you come to Nigeria, they have one of the strongest compliance framework. If you go to Senegal, several countries are so aware of, I would say, de-risking, that they bring a framework which is very, very stringent to local banks. And then inducing the need to invest in compliance. But compliance is costly, more and more costly, because it's about not my 10 fingers, but technology. We're now talking about AI. And the efforts to invest on those parts is there, okay? But I think that if we identify main actors, today, I have the ability to do transaction monitoring on the customer of the FI which comes to me, which none of the correspondent bank has ever done in Africa. That's what I'm doing, because I'm so afraid of being de-risked that I invest that level of time and effort to show to my correspondent bank that they can come and work with me. But most of the time, someone is seated in the 9th floor, like I was saying.
We talked earlier.
Yes,
every tower somewhere.
Yeah, and then decide that nope, we're not going there because we've been fined. But actually, you've been fined because of you.
Yeah.
Right.
Not because of me.
Yeah.
You took some decision to open an account to somebody, etc. But it's not me. So identify your errors and split it from the fact that you have to streamline relationship with another entity which must be given chance to live.
Yeah.
This is quite philosophical debate.
Yeah, but it's practical. Last year in D.C., we had the Caribbean Association come, many of the banks. And there was a bank in a certain country in Latin America, and I don't want to say too much because I don't want to, but a bank, it was owned by a foreign bank. Mm-hmm. It was in Central America, a foreign bank. Okay, that bank sold the bank, so now they're independent. So they used to have correspondent services. As soon as that foreign bank sold them, they were cut off. Mm-hmm. Exact same systems, exact same programs, and so it wasn't really about. Anyway, that's just an example. And they were here at BAFT to try to help.
But it is a good example, right? Because it ultimately comes down to, the lack of trust, lack of confidence with your correspondent or the counterparty, right? So you mentioned about whether there's a solution. Possibly, right? So I sit on a development board for a company called GSS, and we have something that's called Project Rose that's actually right now in proof of concept with a number of banks. There are 150 banks that are participating in this, but it's like taking sanctions screening to the future, right? So it's basically coming up with a centralized sanctions screening approach, right? They have the filter, list management, et cetera.
Utility.
It's basically utility, but it also includes first level review leveraging AI. They're partnering with a company called Silent 8. And the proof of concept we're doing right now, it's like, although it's Canadian and we're doing it in partnership with other Canadian banks, they're trying to also do this, deploy it regionally. We do have a bank in MENA that's participating, banks in Asia, there's one US bank. But the goal here is really to reduce friction. And we talked about it, but it's not just lip service. It's in the sense that because SWIFT is also partnering with it, one of the biggest impediments, right, to actually clear payments is the RFI process, right? Everybody who does payments knows what that looks like. This will help eliminate it because it's actually, they're all using the same solution if it's partner banks. So it helps eliminate that RFI process, right? So you actually can contain your traffic, your information that travels on SWIFT, but you're using a common solution that's held to a very, very high standard. So like 100% effectiveness, and the efficiency numbers are there too, right? They're coming in at around 1% in terms of the alert rates. Each bank manages their own second or third level alerts themselves because they want control, right? Have to. And then each bank can also do their own testing and they get centralized model validation. So you can actually rely on the solution. The whole goal of this is be able to deploy it globally, not just for the large banks, but for the small ones. So then the actual pricing on it will be on a per transaction basis. Then the goal is to start with SWIFT traffic, but then also deploy it for other solutions, whether it's securities screening, security settlement, but also real-time payments. So I think there are possibilities out there, but just how you approach it, right? It's really regulatory side needs to come first as a solution, right? So it's not that I'm going to criticize some of the digital offerings, but it seems that AML and sanctions is often left to the side and it's an afterthought. You can't build something where you don't, at the forefront, think about regulatory compliance because it's going to come back to bite you.
Yeah, so I mean, it sounds like there are potential solutions, right? It cannot be done from just one side, such as Idrissa said, uplifting the compliance regime across the banks in emerging markets. That obviously needs to happen and has been happening for the past couple of years, but there also needs to be an approach from the top, right, in terms of the public-private partnership, creating these utilities. I know we have some questions around synchronizing the sanctions lists across the jurisdictions. I'm not sure that we will be able to achieve that because those lists are actually driven by different political regimes. So I think there will always be some divergence in terms of the list globally.
You will always have global divergence, right? Yeah.
But it seems like there is potential light. It's just the solutions cannot be done just from one side and fixing the emerging markets, but it also needs to come from the global banks, the public-private partnership, and then, as Mark pointed out, the social aspect, right? The S under the ESG.
Yeah, let's focus on S, big Superman S, right?
Exactly.
And can I point out the best quote? I mean,
Yes.
we've really had fun, the four of us talking about this thing. And I ran into Idrissa for breakfast, and he talks about that, about having empathy in banking.
Yep.
And I just think that's important. There's a cause that's greater than just.
Yeah,
you know.
because you see the message today. Everybody wants to help Africa. Everybody wants to do action, raise fund, etc. But if our institution were doing the right thing, okay, nobody would need to raise money for Africa, because we have people who are ready to do the right thing. The ideas are there. We're looking for collaboration to promote those ideas. It's just a question of having a certain level of trust on our ability to align with best practices, because we're part of this world.
Yeah.
And we're part of those people designing the best practices. So we cannot just come and say, no, these people are not able to align with best practices.
Yeah.
So no, that's not true. We in my bank, we all have experience. I worked for 20 years in Europe before joining Afreximbank. My colleagues are also exposed people. So we know how to do and what to do.
We know the right way to do
Yeah,
things.
to make it happen.
Yeah.
And we educate people. Look, we collaborated with BAFT during COVID. We went to do compliance training in West Africa, Lusophone Africa, Arab-speaking Africa. But what's the impact? Nothing.
Yeah.
This did not help me to have more correspondent banks. So, but I have my duty in line to promote trade. I have to educate my population, my community. And this is my day-to-day, actually. And I'm just expecting, and it is a call for this audience, that people rethink the way they see Africa. And it's going to make a change in the way trade. It's not normal that we are less than 5% of the global trade, while with all the potential we have petrol, we have lithium, we have everything to make things happen, and we're out of the game because of some people have decided that we were not able to do it. That's not fair.
So maybe, thank you so much. Maybe to conclude, because I know that we are just keeping you away from lunch, but I think obviously de-risking is real. Sanctions is very much the number one factor, or one of the number one factors contributing to that. I think we can conclude that we have perhaps completed step one against de-risking, which is uplifting the programs in the emerging market, the compliance programs in the emerging markets. And the next steps perhaps are what Mark talked about, the ESG, which hopefully we can use the S to incentivize the global banks, the global community to look at de-risking, right, under the social aspect, perhaps to leverage the ESG metrics to quantify the S, I think perhaps through the cost of compliance. Right, we talked yesterday about how that is qualitative and very hard to measure. Perhaps there are metrics that we can develop around that to incentivize the global banking industry. And last but not least, I think very important what Stephen had to say about providing banks, the large, the regional, the smaller ones in emerging markets, providing them with the right tools, right, such as the utilities and
global
the
global low-cost solution, and then we need more collaboration. I think that's what we need to do, right?
And like what Idrissa said, we need to talk to each other.
Yes. So with that, thank you very much to my speaker panel.
That's good.
That's fantastic.
Thank you.
All right.